Robert, so you're still here, right? You didn't win the Powerball?
Still present. Haven't won the Powerball. I've been dreaming about it, but yeah.
Who won?
Someone in Texas, someone in Missouri, I think, and they divided it up.
Really?
Yeah. I think it's 800 and 800.
Okay. Did you say you didn't even play?
I was planning on playing, and I just never got around to purchasing the ticket. And that's my bad, because someone in Texas, relatively close to us, won. So it could have been me.
Could have been you.
Could have been me.
That's the slogan, right?
Sounds like a
lottery?
sad
Lotto slogan.
It's right for myself.
It's always. It could be. Why not you? Yeah.
Should that be our marketing strategy from now on?
It could be you.
Avidian. It could be you.
Welcome back, guys. The Ask Avidian podcast. I'm here, joined again with Robert Palmer. I'm Jake Borbidge, Chief Investment Officer here at Avidian Wealth Solutions. We got a few things to chat about today. It's Thursday, and it's the Thursday after a Fed rate cut decision.
Woo!
Whoop, whoop. The market had largely forecasted this one into a guarantee. A number of weeks ago, I think the Fed had done a really good job of telegraphing what they were going to do. I think we blogged about this a little while ago. We said don't call it transitory, but in effect, the Fed is starting to, kind of take that narrative with inflation, and even though inflation is still elevated, definitely above the 2% target. I mean, it's not blowing the doors out, but you're still seeing inflation kind of touch the threes, and you're starting to see purchasing manager prices climb a little bit, so moving in the wrong direction. I think what the Fed has kind of telegraphed is that they're gonna give inflation a little bit of slack. They're focusing a little bit more on the employment picture.
Yes.
And they're kind of using the narrative of, okay, well, there's tariffs, there's volatility that's going to drive volatility in prices, and we don't want to react to kind of tariff-driven inflation too aggressively, because mathematically that could just be a one-time spike. Now, we've been talking about that for a long time on the Ask Avidian podcast. We telegraphed that months and months ago, but we know what we're doing, and the Fed is finally starting to listen to the podcast, I think, and they're starting to pick up on some of the advice we've given them.
We're highly influential.
Yeah, we definitely are. I mean, even if they don't follow, right? But you should hit the like button. You should follow our podcast. So Fed rate cut 25 basis points yesterday, so quarter point. Market is still forecasting a few more cuts this year. I think 2 more cuts this year, another one next year. So that rounds out to about 100 basis points of total easing through this kind of modest cutting cycle. That brings us down to the low threes if we get all of those cuts, mid to low threes, I think, but maybe 3.25. If you look at the Fed data and their kind of what is coming out of their meeting, they're a little still all over the place, a little bit of a house divided. You got some people actually calling for a rate hike. 1 or 2, I think, said rates may end the year higher, which is a little bit of a head scratcher.
I can't fault them too much for being a little all over the place, though, because to be honest, we see this uptick in inflation, this downtick in employment data. They want to ensure full employment, so they're providing some liquidity with a rate cut. But at the same time, we haven't even worked out the China deal yet. So we don't even know what the imports and exports are going to look like on that end, and that could have an impact on pricing in the short term. So I kind of understand why they're all over the place, because they don't really know how this is going to shake out, and they're trying to thread a needle. And believe me, I have a high bar for them. I want them to get it right, so I'm definitely overly critical, but I also have some compassion for the situation.
Right, and how do you even define getting it right?
Exactly. Yeah.
So they've got 2 jobs, right? Control inflation and then, get us to full employment.
That's right.
And those 2 jobs, and, you could say, well, it's just 2 things, right? All you got to do is 2 things, but it's for a pretty big, you're steering a pretty big ship.
Super simple things to do.
Yeah, super simple. I mean, it's just like 2 things, right? No, you've got employment, and you've got inflation kind of moving in opposite directions.
Right.
And, the news tends to really oversimplify the tools at the Fed's disposal. They really, inflate the importance of the Fed funds rate, but that's not...
No pun intended.
Huh?
No pun intended.
Oh, man, I shouldn't use the word inflation. That's going to be a
inflate
4-letter word pretty soon.
Yeah.
Unflate. Should I use unflate? Deflate's a bad word,
Deflate's
too.
a bad
You don't
word.
want either one of those. You just want flate.
That's just flating.
Yeah. No, so you've got these 2 things you're trying to solve for. I think what came out of the meeting, too, is that the Fed is definitely seeing, or at least, kind of more often than not, they're seeing the upside risk to higher unemployment as a bigger risk than the downside risks to inflation. And from a growth forecasting perspective, the expectations around growth for 2026 and 2027 beyond are continuing to soften. I think a lot of those expectations are softening mainly from a reduction in trade, but that does have an impact on overall growth, because if there's less global commerce, that definitely has a lag a drag on growth, right? So softening of growth expectations, firming of inflation expectations, and again, don't say the word, but that kind of sounds like something that has horns and looks like a deer with inflation at the end of it.
I do want to follow up on something with that, because we've seen a couple of new IPOs over the last couple of weeks, and I'm just wondering, with these rate cuts, do you think that there are going to continue to be more IPOs moving into next year, or do you think that we're kind of going to level off? Like, if earnings are going to soften, does that mean IPOs might defer out for more fertile economic conditions, or do these rate cuts present the fertile economic conditions they've been waiting for to actually go public?
Yeah, so I mean, that's a really tough thing to answer, but I think the first thing to bring up is earnings versus growth. When we talk about growth and what the Fed looks at, they're typically looking at GDP growth, not necessarily earnings forecast, right? So you can get not necessarily earnings growth. You can get earnings growth with slower GDP growth. You can expand margins, like you can do things to juice your earnings. We've obviously got some tax pictures in play as well that may help to boost earnings. So you may have a situation where you've got some more robust than expected earnings growth, but maybe GDP growth doesn't look as strong.
That's a good point.
And so I think one of the things that you're seeing in the IPO markets, number one, there's a backlog, right? And so really what you need for IPOs to take place, you need buyers and sellers to agree on some range of price that is acceptable to both sides, right? And that's any transaction is like that. Last couple of years, I think those buyers and sellers have been far apart. One of the reasons likely is because rates have been higher, and so the buyers are saying, well, I got to discount your cash flows a little bit more aggressively, and the sellers are saying, well, rates are going to come down, don't worry about it, and elevate the value of my firm, right? So now that rates are coming down a little bit, I think that does play into the calculus. The first cut, this 25 bips, it's an incremental, but if you end up getting 4 of those together, 100 basis points actually has, if you reduce your discount rate in a DCF model by 100 basis points, it has a pretty meaningful impact on the overall, call it intra-year values as well as the terminal value of the investment. So you definitely have the odds of buyers and sellers getting together on a price go, definitely higher in a lower rate environment. So potential tailwind. We definitely like seeing the thawing of the IPO market, because I think that unlocks a number of other things in private markets. So that's always positive to see. And kind of where we get cautious is if you start to see an overheating, right? Now we've seen some pretty well-received IPOs, but I think for the most part, there's been a couple that have had good pops. But for the most part this year, you're seeing decent interest levels in IPOs, talking about them being, generally oversubscribed and modest appreciation on the first day of trading, but then generally just kind of a moderating of, the volatility on those stocks and the trading and activity in those stocks in the following days, right? So that, I would say, is probably more indicative of a healthy but not overheated IPO market. However, that can change quickly. And I think one of the things that's kept that, I would say, activity a little bit more muted in terms of the amount of pop is the level of passive investment taking place today versus back in the 1990s, right? So in the 1990s, the bulk of capital, institutional capital, retail capital was run more by active managers. There was significantly less, if any, indexing going on. So an IPO comes to market, the pool of capital that's looking at that IPO and may take a part of it is, proportionally much higher than it is today. If you own an index fund and that index fund is tracking the S&P 500, that index fund is probably not looking at the IPO market to allocate capital to, right? It'll wait till that IPO becomes one of the index members, and then you'll see, potentially some appreciation when it is included in index membership. You'll get some additional follow-on inclusion. So something, just kind of a dynamic that's a little bit below the surface that might lead to more of kind of a modest but more drawn out warming of the IPO markets.
With regards to the IPO market and public markets in general, I want to ask you a side question, and you don't have to go down the rabbit hole, but I'm really curious on your perspective. Right. I know Trump posted the other day on some social message board that he wanted to, instead of doing quarterly reporting, to do semi-annual reporting for companies. So that way not everything's based on.
I heard that.
What's your
It's very
opinion
European, right? I feel like that used to be the thing that people did in Europe.
Well, I'm very confused by it because, to be honest with you, on one hand, I think quarterly reports provide transparency more readily available for the investor to make decisions more regularly. However, at the same time, it means everyone's pushing up to that quarterly deadline to make earnings look as good as possible for that quarter, providing a more short-term perspective on business management rather than a longer-term perspective on business management. What's your insight on that?
So I think it's a little bit of a bittersweet. Hard to decide what the right answer is there, but as an investor, right, we kind of live, eat, breathe, sleep data, and when there's no data, we can't really make new decisions or can't update our opinions, right? And so, investors generally, I think, want to consume more data than less, and I think investors would probably say, well, we have some really interesting technologies available today. Why can't you tell us what your revenues are real time? The day of, right? And we actually have some private companies that we invest in and some private sponsors that own portfolios of private companies that are actually doing that, right? They are looking at revenues on a daily or on a weekly basis, aggregating up observations, using that insight to help mold portfolios. So going to lower frequency as an investor, I would generally say is not something that I'd be all that excited about. And it also creates some challenges if you have different frequencies in reporting in one country versus the other. And I know we've had that in the past. As an investor, again, if you're a global investor, that makes researching these companies a little bit more difficult. However, also a business owner, right? And I understand that getting financials together is cumbersome and it consumes resources, it consumes time. The amount of time and resources going from quarterly to semi-annual, you're probably not safe. You're not able to lay off anybody or reduce your headcount just because you have to report 2 fewer times. But does it open up, more of kind of a longer term mindset for executives in their decision making? I think that is a potential positive, right? And so what that likely means is that, if you have to talk to your investors less frequently, you don't have to worry about the short-term impact of a potentially long-term, really positive decision that you've made. So I think there's some potential positives there. Allows your CEOs, your executives to align more with longer-term outcomes of a firm. So that, I would say, was definitely kind of the balance, right? So hard to know what the right answer is there. Yeah. Definitely some competing interests. President Trump, obviously more of a business owner-minded individual. I would expect to lean towards that less frequency mindset.
From a financial planning standpoint, I also thought about it as sort of a hedge against investor psychology, right? So if you have like a do-it-yourselfer that's looking at quarterly earnings, they could make snap decisions and their behavioral patterns could actually make bad investment decisions because they're no longer thinking long-term. Mm-hmm. We met with a client the other day, and this type of investment was an alternative investment. It was on a J curve. So it was taking depreciation now, showing almost a negative return, but providing tax alpha with the expectation that within just a year or two, it was going to ratchet up and sell some of the assets that had been depreciating. Yeah. But if you're getting quarterly reports showing you that you're losing money every quarter, you might be inclined to sell before you get that upward momentum.
Yeah. Just don't tell me how bad you're doing, right? Is that kind of what you're getting at?
Right. But at the same time, I want people to be long-term investors. But to your point, I do like having more information as opposed to less. And I think the best hedge you can have to avoid that behavioral psychological risk is just working with someone that's going to be able to tell you it's going to be okay. Think long term. Here are the pros and the cons. You know the risk.
Thank you for that reminder. It is going to be okay. Yeah, guys. It's going to be fine.
It's going to be just fine.
So let's shift. I mean, we're still talking about rates, but mortgages, right? Mm-hmm. So mortgages have shown a little bit of volatility, a little bit of softening in mortgage rates leading up to the Fed funds cut this week. I think you could probably say that they had priced in a cut, and then there's some, reaction there, some softening of rates, right? For sure. So, how do we see that impacting, our clients and kind of more market broadly? What do we expect there? Yeah,
clients tend to fall within two arenas. Either they refinanced or bought a home during COVID, in which case they have a rate they never want to get rid of because it's 2 to 3%, or they're looking, or they're in the market, I should say, for buying a new home today, and they're trying to figure out the best time to buy it. And I think the tricky part with that is as rates come down, typically housing prices go up because of that discounting factor you brought up earlier. And as rates go up, financing becomes harder to secure, so housing prices tend to come down commensurate with that. As we're looking right now, these are some of the best rates that we've had over the last 2 years. Whether or not they're within your budget, that depends on your financial plan.
Yeah,
that's a shameless plug.
Well, that's a good point. Yes, you should have a financial plan. Absolutely. And it should be done by a professional. But I think, if you look at the affordability, right, this quarter point cut, and maybe you've seen, maybe a quarter or 50 basis points, depending on what you would call the high point on mortgage rates.
Yep.
They've come down, maybe a little bit more than a quarter point over the last year from the peak. Affordability is still, much more in favor of renters.
Yeah.
And so I think, while it'll be a welcomed, kind of slightly better improvement on affordability if you're looking to move from an apartment, from a renting situation to a single family home, there's still a pretty big gap, right? You still are either having to bring a ton of money to closing to keep your monthly payments the same, or you just got to suck it up and have much higher monthly payment. And from an investment perspective, maybe you can kind of get comfortable with that. Maybe you think, okay, well, the value of my home is going to appreciate over the long period, so the long term. I would advise people, if you're buying a house, never buy a house that you don't want to own for more than 5 years.
Absolutely.
But so if you factor that in, maybe you kind of get some of that some of that interest payment back. But it's still a pretty big pill to swallow in terms of going from maybe it's a $2,000 monthly payment up to a $4,000 or whatever that monthly payment is that you're looking at. It's a pretty big gap.
Your tax planning really needs to kick in too. The One Big Beautiful Bill Act, the OBA, set up some new state and local tax deductions where some property taxes could come into play, especially with your mortgage interest rate deduction, depending on where you live. So that is something that would require a balancing act to determine if purchasing the home with the carrying cost is worth it. And of course, you and I talked earlier over coffee with lawn care, which I won't get into, but my God, is lawn care just so annoying sometimes.
Yeah, most people, things like that, most people don't factor into the cost of owning a home. But, a lot of people don't like cutting their own grass. And the grass grows, right? Somebody's got to cut it. When you own the house, it typically falls on you unless you want to pay somebody else to do it, right?
Or get a cow on there and get the ag exemption.
There you go. Yeah. Just get enough grass that you can have a cow on it. That is a good strategy, everybody. Part of your financial plan.
There it is.
So sticking on the topic of rates, but pivoting a little bit to a different asset class, private credit and rates, right? So you could say, well, mortgages and the Fed funds rate, there's some relationship there, but over the short term or the long term, there can be a disconnect, right? You can have very flat yield curve, which means that the Fed funds rate and mortgages are tightly integrated, or you could have a yield curve that is very flexible in its slope, and your mortgages could kind of float in different directions from where the shorter end it is, right? As it relates to private credit, now we've got a step down in short-term rates. From a private credit perspective, you're not dealing with interest rate risk in terms of duration. So a step down in rates means a step down in yield on the private credit side. It's not a same day adjustment. It's typically maybe lags a couple months or a quarter depending on when the rate cut happens. But our expectation is that you're going to start seeing a lightening up of the yields on a lot of the private credit funds that you're looking at or that you might already be investing in. Is that kind of what your expectation is, Robert?
Yes, I think that aligns perfectly with what we're looking at. And I think the other important side of that coin is making sure that the positioning of that private credit within your portfolio is accomplishing your goals. So just going off that, you have yield coming in that could potentially be taxable depending on where you position it, or it could be non-taxable depending on where you position it. And I think that with yields where they are, it can supplement your income streams quite efficiently, particularly if you're in retirement and you need the income. Yep. But if you don't need the income, or you're trying to sort of maximize your tax outlook, there are really only two solutions to accommodate that higher yield that private credit can provide you with. And that is either having it within a retirement account somehow, so you get tax deferment on the yield and you're able to save more, or wrapping it in some kind of insurance product like private placement life insurance, where that yield can grow at a compounded rate without there being a tax implication, and potentially pay out tax-free at the time of death, or be pulled out in the form of loans throughout your lifetime. So those would be the two tax-efficient ways to go about doing that. And I know that's a little complicated.
Yeah. So if I'm looking at, so most of our clients will have a retirement plan in place, and they'll have an IRA, and maybe they're doing some, private credit in their IRA. And that's a pretty, tax-efficient decision. On the PPLI side, right, private placement life insurance.
Yep.
What is so you're saying that you can take a private credit vehicle or a private credit investment that pays out, our private credit investments are paying out, kind of low double digits, maybe high single digits in income today. That number is, expected to fluctuate over time, right? So we're just kind of making current observation, but it'll fluctuate over time. But generally is a a good tick higher than what you can get in a tax efficient municipal bond, right?
Definitely.
And as long as that continues to be the case, right, you have this yield advantage, but you have a tax disadvantage. So you're saying that you can make that you can keep that yield advantage. You can also capture a tax advantage, right? So you turn something into kind of both, you're getting both benefits. What's the drawback to doing that?
Yeah, the drawback is that this is really about long-term investing, not short-term gain. So a lot of investors are looking for a quick turnaround. This is not one of those solutions. It's also a little bit more complex with how you're able to pull money out and when the money comes to your heirs. So it adds a little bit more of an administrative burden on the investment.
Okay.
So the way that this would normally work, if you were just in an ordinary taxable account, the yield is going to be taxed at your ordinary income rate, the short-term capital gains rate with NIT potentially, right? Net investment income tax. So you're paying 40.8%, and we haven't even.
So if you had a 10, you're down to 6 or less,
you're
right? Okay.
Way low, and that doesn't even account for state and local taxes because we're in the great state of Texas.
Yeah.
So we only have the federal tax to worry
about.
Well,
we only talk to Texans on this podcast,
that's
right?
But you see, if you have it inside of a life insurance wrapper, which is a fancy way of saying, here's a life insurance product that's paid for with premiums, and there's an investment account that increases the value of the insurance over time. What increases that value is basically a sub-account that's invested. Mm-hmm. And one of those investments can be, or the entire thing could be private credit. And so you could have this nice 10% yield that's compounding tax deferred with no tax implications year after year after year, just adding to the overall portfolio value.
Okay.
And the way that this would work from a logistical standpoint with how you could gain access to the money despite it being within a life insurance plan is you're able to pull loans out against it, and loans are non-taxable. Now, those loans
You mean the distribution that you take out is non-taxable, right?
Correct.
Okay.
So you would pull it out in the form of a loan. That would be non-taxable. The sub-account keeps producing yield, keeps compounding. But what you're doing when you pull the money out is that you're effectively reducing the death benefit and the available value that you can pull out in the future.
Okay. You have to pay it back?
You do? Well, you ought to. You don't technically have to because it can actually be negated with the death benefit, but that could potentially cause a tax implication at the time of death.
Okay.
So you want to be very careful when working with your insurance provider or broker and your financial advisor that you account for that appropriately. But if done right, you get this wonderful tax deferment on the private credit side. You're able to pull out the loans tax-free to help pay for costs or lifestyle throughout the ages.
Mm-hmm. Yep.
And then when you die, you get a huge influx of tax-free money in the form of a life insurance benefit. And you could house...
And that goes to your heirs on a tax-free basis, right?
And that could go to your heirs on a tax-free basis. And if you want to get really clever, you could house the whole thing in irrevocable life insurance trust, also known as an ILIT, and it could be estate tax exempt as well.
That's awesome.
Yes.
What I heard there is if, right? If done right.
Done right.
So I think that's the key, right? So I think our best guidance there is if you do this stuff on your own, this is probably one that gets a little bit more complex unless you've got some degrees in this particular subject. It's probably an area where you want to get a professional involved, right? Is that fair? The other thing I heard is there are fees, right? Insurance.
Yes.
The bell that typically goes off in my head when I hear insurance is I think high fees, right?
Yes.
Is that the case with PPLI? Is PPLI inherently a high fee solution?
It definitely can be. So it's very important to work with a broker that's able to outsource and bid with multiple different insurance providers to see who's going to provide the best rate. If you do it right, it should cost you no more or around the same price as it would for an advisor to manage your portfolio.
Okay.
So you can get a fee structure that's very similar to what you'd ordinarily pay on a typical investment account managed by an advisor if you do it right. So you just have to make sure that you get that transparency.
Okay. Awesome. So let's pivot off of private credit. So again, going back to the rates and the impact on markets.
Yep.
Impact on private credit, maybe a little bit of a headwind. Although you could say, well, the odds of a firm not being able to meet its private credit obligations may improve, right? So you are definitely easier to make your interest payments if the interest payments are lower, right? So while the income produced from a private credit investment may go down, the expected losses, all things equal, may actually improve a little bit.
Default risk comes down a little bit.
Default risk, yes.
Yep.
So all that said, let's pivot to the equity side of things. So private equity, small caps, I think both tend to respond positively to a cut in rates, mainly because they both share some similarities in terms of borrowing. They tend to borrow over shorter periods of time, or they tend to borrow at a SOFR plus or a prime plus rate, right? So those businesses, while you see the private credit, the lending side, take a reduction in income produced, you're seeing that flow directly, or I guess not flow directly, but not taken out of the equity side of things, right? So, a couple years ago, we started seeing rates increase. We talked about a great the great transition in earnings going to equity holders versus going to bond holders, right? A greater share of firm earnings, company earnings were going to the debt holders because of higher rates. Now we're starting to see a little bit of a shift back in the other direction, right? So a couple data points I think are worth pointing out. From a markets perspective, do Fed fund rates tend to forecast higher equity multiples, higher equity prices, positive equity returns going forward? I think the data generally shows that yes, they're on average, when you have a rate cut or the start of a Fed rate cut cycle, the returns on equities after that rate cut, 12 months out, they're generally more positive than they are on average, right? Yep. Now, on average, right, if you own equities for 12 months, 12 months or longer, on average, you still should be positive. That's why we own equities in general, but there's volatility there. So the odds, if you're owning equities as the Fed is cutting rates, the odds are a little bit more incrementally positive in your favor. At least that's what historical data has shown, right? That doesn't necessarily mean that it's going to be the case, over the next 12 months. However, on the private equity side, and again, we mentioned the IPO market warming up, what we're seeing on the private equity side is more deal volume. And that's kind of been the trend for most of the year, with I'll call it a little bit of a pause during Liberation Day and, kind of the 6 to 8 weeks after Liberation Day. But generally speaking, we've seen more M&A deal volume. And you read about the IPO side of it more because it makes it to public markets. It typically is well covered by news. But we've seen a lot of private transactions as well, right? So that means that private business owners, both large and small, are starting to have opportunities to exit businesses that they have built, right? So sometimes it's the founder. They've been with the business for a long period of time. They're looking to exit and retire. They may be looking to exit and start something else, sell their business to a strategic and start a new endeavor. So all of those things I think are good things for our clients because it provides them liquidity. But Robert, for us, how do we interact with those business owners who are either new recipients of a liquidity event, or even better, are preparing for a liquidity event, seeing the market soften, seeing the market warm up, that they think, okay, this might be the time to exit the business that I've built over the last 20 years?
Yeah, it's a great question. I think I'll start by just talking about the business exiting strategies. When it comes to business exits, someone who's anticipating some kind of liquidity to come in for the sale of their equity or the sale of their business assets, it's important that they have the right structures in place to make sure that it's tax efficient, particularly for themselves and their heirs. So usually what we'll do ahead of the sale is first make sure that the transition plan is outlined. So are they going to stay within the business and continue to operate as an employee or as an owner, or are they taking a full step back out? That changes the tax perspective and the cash flow. Rather than getting one big lump sum, they may get payments over time. And so the idea would be is, hey, based on the cash flow that's coming in, when should you be recognizing certain losses, and how are those losses and gains going to be taxed, and how can we model this out in connection with your portfolio to ensure that there's some tax optimization? Now, as you could probably already tell, there's a lot of moving pieces in this, and this is where working with a professional really helps out, because as good as individuals are at running their own businesses, when it gets down to the nitty-gritty of the financials and the tax treatment, it is so burdensome to track everything. And so having a little bit of help, some oversight, and a second set of eyes modeling this for you, it just provides a lot of peace of mind. And I would add that when it comes to a liquidation event, you want to make sure the right type of estate structures are in place. So, for example, if you are a C Corp and you're selling and you've had the company for over 5 years and the shares were issued at a certain time that make it qualified for qualified small business stock, which is a section called 1202, you might have a $15 million exclusion on the gain of the sale of that business. And the cool part about that is that if you structure it correctly with your heirs or your family members, there is potentially a way to give shares to those family members, and they each get their own $15 million exclusion on that gain. So already, this is just a hypothetical where you can see that the proper planning can save a ton of money in taxes.
Yeah.
And it's not just limited to C Corps. It extends out to S Corps as well. Not the same exclusion, but different types of sale treatment. S Corps can be an asset sale or a stock sale. And the beautiful thing about S Corps is that you can actually qualify for both. You get the best of both worlds. The seller gets a stock sale treatment, long-term cap gains, and the buyer gets an asset purchase outcome, so they have something to amortize and depreciate.
You guys can tell that we get excited about this stuff here at Avidian.
I love this stuff.
Yeah. Now, I think like the numbers, the dollars and cents of it, they make a ton of sense, right? But I think what you touched on just a little bit is the emotional impact of being a business owner and running that business really well and building this thing up, sometimes for your entire career.
That's right.
Letting go of that and then having the different role of receiving a large liquidity event can be a little bit unnerving, right? And, you kind of think about, okay, well, you're selling a business, you get a large cash inflow, that's all, time for celebration. But, that change in a role from a business owner to more of a financial manager, that can be, incredibly stressful. And I think, one of the things that you touched on is like, we're trying to make both the sale process and also what happens next be something to celebrate.
That's right.
But it does take a lot of planning. When would you say is the time to get somebody involved, get a professional involved in terms of planning for the exit? Is it, once you've identified a buyer and you've come to terms, is it, 2-3 years before, or is it, money hits and then I just kind of move it around to where it makes sense?
Yeah, I think as early as possible, some kind of exit plan should be outlined. So for example, if you plan on transitioning the business to the kids or something like that, day one that you start the business, at some point, once you realize that you got some good revenues and some profitability, you should be outlining a transition plan. If you plan on bringing in a buyer and selling out your equity, you should have a baseline understanding of the types of tax events that could be incurred based on the types of sales structures that apply to that particular business sale. That should all be modeled out so you have an idea on how to negotiate and you understand the discount values that are going to be thrown your way. Because just because you get a large number doesn't mean you're getting the best outcome. I have seen firsthand larger checks be cashed and less net take home be the result. Just because of the way it's structured. It's not good.
Yeah.
And one of the things that I want to touch upon that you mentioned is the stress of going from a business owner to a financial manager, if you will. And this is what typically happens. I'm just telling you based on experience. You will sell your business, you come into this liquidity, you say, I'm now going to enjoy my life and play golf and just have a good time. That lasts at most a few months before, guess what? You're trying to start another business. And that's what winds up happening. You get bored. And especially if you're productive and successful.
You find out that you loved it, right? It wasn't just the money. You loved doing it.
That's right. And you also realized you build this skill set that you can now take and have the same success again and again and again. And it becomes a game. And you have fun with it. So you get off the golf course and you say, I want to set up this business, but my God, I forgot about all the logistical and administrative burdens of setting this up. This is where more planning comes into play. You come and work with somebody like us here at Avidian, and we can actually help identify how the operating agreement should be structured, what kind of corporate entity you should have. We can help identify the transition plan on day one, and we can kind of take away some of that administrative burden, giving you the most valuable thing back in your pocket, which is time.
Yeah, I think that is a really powerful story, because if you were the individual that started the business, a lot of these guys that we deal with, right, they started the business with just themselves or themselves and a couple friends or a couple close, relatives.
Yep.
And you're just doing everything. You're wearing every single hat.
24-hour days.
And we're saying, okay, well, the next time around, let's take some of those hats off and give to a professional, right? And do what you're really good at, what you've honed in on your skill set over the last, 20 plus years of, a specific, managing the business, right?
Right.
But not wearing every single hat, not doing the taxes, not doing the finances, hire a professional to do that. Yeah. One of the luxuries you get when you have an exit and you get to start a business from scratch with some really intelligent partners alongside.
Absolutely. You're starting on third base instead of starting all over again.
Yeah, that's great, man. I love getting walked to first, second, third. All right. Y'all, this has been a lot of fun. Hope you guys have enjoyed it. If you want to take any of these discussion points any further, just come check us out at avidianwealth.com.